You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it's time once again for TWIFO, This Week in Futures Options, the program where, as the name implies, we look back on the week that was and indeed still is on the futures options side of the fence. So maybe that's metals, maybe that's ags, maybe it's indices, maybe it's all of the above, crude. You never know what's going to make it onto the old show every week. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. And, of course, for all of you who love to have your futures options info, you can't wait for the podcast. You have to get it in your ears right away. Well, we make it available to you live every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern, via Mixlr. So head on out there, grab that link via our social media, wherever else you come across our content. And you can join us every Friday. Questions, comments, insights, pearls of wisdom, mocking of Nick's Skype photo, all sorts of other fun stuff. We welcome it all here on the old TWIFO program. Make sure, however you listen live or after the fact, you do send in those questions, those comments. We do actually like to hear from you guys. And since we've mocked him, we might as well bring him onto the show as well. My cohort, my partner in all things futures, options, crime, the yin to my yang, Mr. Nick Howard, the founder of Bantix Technologies and the creator of a little platform we like to use around here called QuickStrike. Mr. Nick, welcome back to the show, sir.
I feel not only have you mocked me twice now within the first 30 seconds of the show, and this reminds me of that Geico commercial. Did you see that new Geico commercial?
No,
where they have a conference call and they're already in the meeting and it's doing very well, and the next thing you know, two people call in.
Yes, I have seen that.
Interrupts,
yes.
And then one's on mute. Now I feel like an idiot. But hey. Good to see you. Sorry I'm not there. Apologize for my photo. All kinds of things I'm sorry for today. So let's get started.
You got all sorts of apologies to make. Well, luckily, we didn't have you in studio today where we got the next back thing. We got our old friend of the show. Hasn't been on in a while, but we're bringing him back on to help us kick off the new year, talking all things index. He is Sean Smith, the Managing Director of Derivatives Licensing and Exchange Data over there at FTSE Russell. Try saying that 5 times fast, Sean. Welcome back to the show.
Mark, thanks for having me. Nick, it's good to hear your voice. It's just great to be here. Very excited for 2018.
It's even better to see this picture that I'm staring at here. This is
Nick, that picture. We got to do something about that picture.
This is quality stuff. I should take it down because it's going to distract me for the entire show. But Sean, since you took all the time to come all the way down in studio, we'll start in your neck of the woods. We don't get a chance to talk on enough index action, volatility, open interest, volume trends, all sorts of things. I know when you came on last year, you kind of talked about a lot of interesting milestones that were going on over there with all things FTSE Russell. Of course, you brought the Russell back to the CME, back to the Globex platform. That's been a big driver, I know, for you guys. You talked a lot about that first roll, but it's been a while since we've had a chance to check in with you guys. So maybe we'll start there. Let's look back at 2017. What was that year like for you guys over there in Russell land? What were some interesting trends, some interesting highlights, some interesting developments that really, really caught your eye?
Well, as you mentioned, that first roll was a very exciting period. We've been through another roll since then. The volumes in open interest have exceeded all of our expectations at this point. Through the end of the year and into January, we're averaging 100,000 plus days in the futures. There's quite a bit of options activity. There's average daily volumes north of 100,000, literally on a daily basis. Every sector is trading the product, from props to banks to various areas in retail. There are over 11,000 unique customers trading Russell products on CME Group today. That's huge.
Say that number again. That was
north of 11,000 clients.
That's a crazy number of people.
It's become truly a global product with CME's reach. It's North America, it's EMEA, it's Latin America, it's Asia, where CME's reaches with their partners, and the universe that trades equity derivatives, and the opportunity to have all of the credit efficiencies across the equity suite that the CME offers. It's in what I call extremely fertile soil and is positioned for some tremendous growth in 2018.
Speaking of tremendous growth, one of the reasons I wanted to have you guys on last year, and one of the reasons I want to bring you on now, is because, as you probably can guess, one of the persistent drum beats we heard from anyone trading in anything index last year was, man, there's no volatility. There's the VIX, I think S&P volatility was just anemic for the better part, to be charitable, for the better part of last year, in single digits across the board, which is why I thought it was such a great opportunity for Russell, because that's a product that just structurally, it's built up out of small caps. So structurally, even though all volatility numbers are going to be down across the board, structurally it will be higher. There will be more vol. So whenever people would ask me, where should I look index-wise for more vol, my first stopping point to them was always, hey, check out the Russell, because there's got to be something cooking out there, let alone those moments where, S&P vol and Russell vol would really seem to, they have some sort of weird distortion when we see a lot of spread trading back and forth. But just generally, structurally, you'd think that would drive, particularly to the latter half of 2017, that would drive a lot more interest in the product. Were you hearing that anecdotally from a lot of your clients and end users? Were they starting to come to or perhaps discover or start trading Russell again for that reason, because they were looking for a place with a little bit more juice, a little bit more action than they could find in some of the other indices last year?
Absolutely. I don't want to steal from Nick's talking points and what he'd like to say in terms of the skew in Russell, but in the Russell products. But there's definitely an opportunity there. There's been a lot of conversation in regards to trading strategies, and again, those products are CME and CBOE products. So, if you want to compare vols, Nick, if you want to say a few words, be happy to jump in.
Yeah, Nick,
I'm glad to listen. I don't mind listening at all. So, no, I'll jump in, and then feel free to talk about vol from your perspective as well. What I just did, I just will let you know, I just tweeted the last two pace of the rolls for the Russell that were at the CME. So that will show the tool that's out there and available for people to use. I did the sort of the simplified pace of the roll, but there's also a very good equity-based pace of the roll tool out there on the CME Group website. So, as we approach, we're still a ways away from the next one, but as we approach it, you can go out there and start to take a look at the percentages as we near expiration in the one contract and roll into the other. And, even looking at it, you can see just how the increased availability of the contract at the CME just from the last to the first roll. So, and I can also, Sean, you mentioned the fact that there's the open interest that's available. I'm looking at the futures open interest in volume from yesterday, 100,000 plus futures traded yesterday. Majority of that in the March contract, a little open interest in the June, but nearing 600,000 OI in the March contract. And I went and checked the other exchanges OI for that contract, which is the last contract that's available. At least that's my understanding over there. I think it might be a little bit longer term trade, but only 20,000 contracts open over there with like a 2,000 number in the volume. So you're talking a 50 times volume and a lot more, 30 times open interest almost. So that's some good stuff going on there from a future standpoint. And I'll tweet this thing out too, so people can take a look at that as well. And that's all available for you within the free versions of Quick Strike out on the CME Group website. From, before I jump into my spiel with the whole skew and vol, Sean, anything in particular you want to talk about with the options or any kind of information you want to put forth before we get started?
Sure. It's phenomenal to see over 20,000 contracts of open interest in the CME's futures options, right? So that's showing tremendous growth on the future side of the business. That there's that anchor in the options. The futures open interest was north of 600,000 last week. It has taken a little bit of a dip here. I don't think there's any rhyme or reason behind that other than just normal standard operating daily trading, because the number will jump over 600,000 in absolutely no time and probably stay there. But very excited to see the majority, if not just about all, Russell 2000 futures and options trading on CME, and as expected, right? Again, we have tremendous partners in all of our FTSE Russell products, but the CME is really knocking the cover off the ball in terms of sales and marketing of this product. They have a lot of leads. They have a lot of the way they market the product from a campaign perspective is it dwarfs any type of sales initiative that is out there, and it's just a phenomenal way to create awareness, trading opportunity, asset distribution of knowledge about the product. Their hit from customers are presented not only opportunities for the product, but also availability and ways to trade the product and educate them on the ways to do rolls, the ways to trade blocks, the BTIC technology. CME has pulled out all the stops on making this product as easy and available globally. So it's very exciting to see.
And I know, Nick, you've been following along a lot of those, as you are wont to do with all the indices. And we talked before about the different shapes from a skew perspective that the different indices like to take on. A lot of people write in. I might have some today. We'll see about all things skew out there and some other indices like Russell. So what's been catching your eye out there from a Russell, vol, and skew perspective over the past week, sir?
Well, first, to address a couple things, I agree wholeheartedly with when the first roll came out. I think that's when Sean was on the show the last time. Just the educational videos that the CME put out to help people through that process was great, and even the tools like I mentioned, the pace of roll tool, we had that added right when the first roll happened, so people can get out there and know how it's going right from the get-go. So yeah, there is always a good push from their side, and it always is a timely push. Giving a little bit more detail on the open interest, I went back and looked in TWIFO, which you could do for yourself. I went back a couple months, and the OI in November was around 5,000 at the end of November. In December, it was 11,000, and now, excuse me, in January, it's up 21,000. So you see that steady increase. You got a doubling over the last couple months, which is just, pretty good. So as Sean mentioned, we get used to seeing these big numbers of, multiple hundreds of thousands of open interest, but the fact that we doubled our open interest the last couple months is always a good sign and an obvious positive for the product itself. Jumping into what's going on, not a tremendous amount of volume, like we said. There was probably a total of like 9,000 contracts that traded this week, and still pretty good when you're talking about 20,000 open interest. You're trading half, meaning half of that there. So an increased open interest this week of 2,000. So a 10% increase. And I think as people become more aware that it's available, and as they start to see what it covers and what they can hedge or where they can speculate, that's just going to increase from here. One thing that I noticed or that I read about earlier in the week, I believe there was an article talking about how people had not, it probably was the beginning of the week, how people had taken some of the premium out of the downside index puts because they thought there wasn't so much risk that they had to worry about. So we saw, and I remember looking at the quick skew of it, and the channel tightened, but it wasn't a tremendous tightening, but it was a tightening from where it was. And this week we saw, a lot of people must have read that article or must have traded on it. This week we saw the puts get bid, especially in the near-term stuff, pretty much across the board. But the near-term stuff had the greater bid. That means that contracts under 30 days. And we saw the calls get a little bit more offered from a week prior. So it's following sort of your typical index skew, but it's still, and I think we talked about this way back when we first addressed the initial open interest positions in the trade, and we were wondering what would happen once we got a little bit bigger positions in the open interest or the trade started to be a little bit more fluid. It's still not quite as offered in the calls or bid in the puts as the broad market index. So that's something that we have to continue to watch, and maybe it's just a function of the way that market moves. But it's nice to see an index that's not. I mean, earlier in the week, it wasn't that crazy of a skew between the calls and the puts at all. So, it increased from a vol percent standpoint about a vol to the negative side, but all in all, you had a pretty flat looking curve between the 25 delta options. So that's really, and we have a flat market for the most part from a movement standpoint. I think we had a little bit of up and down here, but vol held pretty firm this week, given where we were and given how the futures moved, and pretty good volume and open interest mixed in across the term structure. So we're seeing the weeklies. The front weekly has the January contract had the most open interest, and then the March is the next one. But it seems to be following a good pattern: increased open interest, increased volume, good underlying open interest. So I think, Mark, we're going to have to make it part of our regular rotation when we hit the indexes with the show.
Yeah, I just like what you were saying there about the skew, because that alone is worthy of merit and discussion, because people get tired of the same old investment skew that they see in the S&P and everything else. I think people have written in this week, why are the puts so expensive? So they have the puts bid, the calls cheap. They kind of been there, done that. So an index that has a little bit more structural volatility, but also has, shall we say, at least can exhibit other types of skews every now and then. I think that's worthy of note, don't you, Nick?
Yeah, for sure. We just have to keep an eye on it and keep the conversation going. I think that's the most important thing. We just got to remember to keep it in the loop, right? We get a little bit myopic with our product coverage. We got to
people are always going to complain. You didn't talk about fluid milk this week. You didn't talk about lean hogs. But Sean, you got to be pretty happy at those numbers. I'm looking here right now. Open interest up 10% in the options just this week. So no wonder why you had a big smile on your face walking in the door today.
Yeah, I'm actually very, very excited. 2018, I think, is going to be a tremendous year of growth for the Russell suite of product. But just really quickly, just to kind of tell folks about the Russell value prop here, there's over $15 trillion of assets benchmarked to the Russell suite of product. 70% of all U.S. equity institutional products are benchmarked to the Russell indices. 98 out of 100 top asset managers and 48 out of 50 of the large U.S. plan sponsors all use FTSE Russell indexes. Almost virtually every investment bank is involved in the Russell index products as well. So there are a lot of eyes. There are a lot of traders. There's a universe out there that is now seeing this growth in this suite of product at CME. The growth for 2018, I'm just extremely bullish on.
Yeah, like I said, just the last couple of weeks, this week alone, I mean, you're 10% growth in OI. I'm hard pressed to think of another product we talked about recently that's had that much, OI growth over the course of a week. So clearly, 2018 and a little bit of this topsy-turvy start to the year, Sean, has been good for all things Russell options there.
I couldn't agree more.
Sean, before we move on from indices, I can't let you go without talking about this. This is one of my favorite, I guess you can call it an old school legacy kind of product over there at FTSE Russell. But now that you guys are I think we're going to be seeing and hearing a lot more of this one. My old friend RVX, which is of course, it makes sense. You have a product like the FTSE Russell, like the Russell 2000, that is structurally more volatile. It would make sense that you would have some sort of volatility product on that index. And so I know a lot of people out there, a lot of our listeners of our volatility show and others in the network, they were big fans of it back in the day, and that we get questions every now and then. Hey, what's going on with that? Is that going to make a comeback? So give us a little bit of inside scoop here, Sean. It's just me and you. There's nobody else listening. What can we expect for RVX coming down the pike?
As I said, or I'd like to say, RVX is a big project of mine. The VIX contract is really a tremendous brand and is a market. Everyone watches VIX, right? But in terms of small cap stocks, the Russell index and the volatility of that index is something that needs to be watched. And there's an opportunity to trade that. And our friends over at the CBOE are happy to explain it, happy to show you how to trade it, various spreading opportunities with that product. Volatility in the Russell suite of products is something to watch, and RVX is the way to do that.
Well, it's definitely on my radar, so I'll be bugging you again about this one in the near future. So next time I talk to you, we'll have all sorts of updates on all things RVX. Really quickly, so we have to keep rolling on with some other products. But any other, RVX aside, this is more of a little passion project of mine as well. But RVX aside, anything you want to leave our listeners with in terms of, thoughts about how 2017 played out from a Russell perspective, maybe some things to look forward to from the Russell complex here before we move on to crude and a few other things.
2017 was beyond our expectations. 2018 is the year of growth. It's the year of adding open interest, adding volume. You're going to be seeing some big numbers in 2018, and I'm excited about it.
I'm excited to talk about it as well. So now you get a little bit of a break. You get to have a beverage, relax for a bit. Unless you want to chime in on all things crude and others, by all means, you are welcome to do so. But rest your voice up for the listener mail, which is coming up in a little bit here. But Mr. Nick, let's tackle another product our listeners like to talk about, let's say once or twice, which is all things crude and WTI. Our friends over there at the IEA, Nick, they seem to like to generate headlines, and they did so again this week. We saw them coming out with a pretty bold headline saying what they termed, quote, relentless growth. Could see the U.S. toppling Russia, Saudi Arabia as the world's largest oil producers. And they didn't say it's going to happen by 2040. They said the U.S. is well placed to overtake the likes of Saudi Arabia and Russia as the world's leading energy producer over the next 12 months. This, of course, is what we were talking about before, Nick, with when does that shale start kicking in? Clearly, it's kicking in. We had some people chime in. Maybe I'll see if I can find it after last week's show, or during last week's show, actually, kind of chiming in with their own thoughts about, the different levels that shale oil becomes economically viable. But they say here the year promises to be a record-setting one for the U.S. Of course, we know the tale of crude has kind of been this kind of push and pull, this song and dance between what's going on with the OPEC cuts internationally and what's going on a domestic production front as well. And those kind of domestic supply, domestic production versus OPEC supply and production has been kind of the main driver of all things WTI. We saw a nice rally out there. I think this perhaps prognostication of a lot more supply coming out of the U.S. in the near term, perhaps weighing on crude a little bit this week. Ended up the week, not that bad, only off a half a handle. So all you crude bulls don't have to worry too much, taking a little bit of a breather. Vol vol off a little bit. Kind of depends where you look. Kind of a mixed bag from a vol perspective. Some terms a little bit active across the board though. Vol coming in a little bit, not exactly unexpected given the what we saw in the movement out there in the underlying this week. We were just talking about FTSE Russell doing 10% increase in open interest. Crude was actually not that far behind, almost 7% increase in OI in that's a big contract, WTI. So a lot of people playing in WTI this week. And in terms of where the action was, Mr. Nick, by the way, listeners, I forgot to mention top of the show, you guys can follow along with your own reports, generate them all live on the fly. If you're listening live or after the fact, make sure you change the expiration settings so you could change it to Friday so you could see exactly what Nick and I are seeing. But you can follow along for yourself, generate free reports, cmegroup.com/TWIFO, TWIFO. And number one with the bullet out here this week, Mr. Nick, was the March 60 puts. Yes, the 60 puts. So maybe some people perhaps worried about a retracement, or maybe just wanting to hedge, or maybe taking some stuff off. Either way, a lot of action there pretty much all week long. It was most active contract every day pretty much throughout the week, pretty evenly split, no one big spike of volume. And actually net opening, about 4,500 contracts net opening on that strike. So clearly the 60 strike, we've seen this before, Nick, in all things crude. People like to gravitate and aggregate around round number strikes, and that was the case out here in March as well. But the call lovers weren't that far behind, but we'll get to them in a minute. More puts first. It's the 57 puts as well. Also out here in March. March kind of dominating the paper this week. 52%, so over half of the paper going up out here in March this week. Nearly 18,000 of the March 57 puts. Again, fairly evenly split throughout the week, and about 5,000 opening there as well. So a lot of new opening paper on the downside here in crude. Read into that what you will. Followed third, so all you crude bulls, you were number 3 on the list this week. 15,000, about 500 of the March 65 calls. Again, all the action in March this week, with the lion's share of those coming today and Tuesday, because of course Monday we were closed, with about 4,500 close to on each. Also 4,600 on Wednesday, so Wednesday also active. Thursday, taking a bit of a break. And let's scroll on down here. We always like to look for we like to look for weird paper sometimes in a lot of these names. And we found it quite a few times here in crude. We had those weird par calls last week, I believe it was, Nick, that seemed like they could be part of a spread, but they weren't in the block trades, and it just seemed like an odd strike. Then we have this week, if that was a little bit too rich, too optimistic for your blood, listeners, we have 4,200 of the DEAS 2019 90 calls going up. 2,000 going up today, 2,200 going up yesterday. All of that opening. So unless they thought the better of it and decided to close today, it seems like we might have more opening paper piling in to the DEAS 2019 90 calls. Total of 4,000 lighting it up this week. So all you crude bulls out there have not been left behind. If that's too optimistic for your taste, we also saw nearly 5,000 of the DEAS 2018 77 calls lighting it up this week, with about pretty much all of that coming on Tuesday. So, and all of that pretty much opening paper as well. So size upside opening positions in DEAS calls both this year and next year. And if you want some put paper, you got to go out to June of this year, where we find the June 2018 50 puts. Actually trading pretty actively this week, every day except for today. Nothing going up today, really. But the rest of the week doing a lot of paper. A total of 5,200 contracts this week. Kind of back and forth, actually, net slightly closing on the week. So strange paper across the board, but interesting stuff nonetheless. Mr. Nick, what caught your eye out here from an OI and a skew perspective, sir?
Well, a couple observations. So the 90 calls you mentioned, those traded on the block as a spread with the Brent crude oil future style margin option that the CME also lists. So there was a 95 Brent and a 90 that was, it's in their buy sell, whatever, that was across. So that was part of a spread, a Brent crude spread. So that's where that's coming from.
I figured that have another leg lurking somewhere.
Yeah, and I think probably that's probably a follow-up to the same trade the day prior. So that's the first thing that we're seeing. Again, the block trade tool is available for free on the CME Group website with about 14 other ones that you can look at. So go take a look and see what we're seeing, and you can do a search by the underlying symbol and select the products that you want to review and see what's happened on the block, just like you can see what's happened on the block by clicking on the most active option. While the show is going on, we have those links are all live, so you can dive right in just like we are.
Nick, Sean actually had a question for you before you keep going.
Yes, go ahead. What's that?
WTI Brent trade, both legs of that were blockwise were CME?
Yes. Yeah, the CME's got this new Brent future style margin option, so I think it's cheaper to trade. But yeah, so it was both CME, which is a good sign, right? When you get that, I don't know how much of this Brent crude oil future thing is traded. I can take a look at that while we're going through the show. I'll search for it and come back to it. But yes, both on the CME.
That's interesting to see.
Yeah,
interesting.
I like when we see that. Here, I can take a look at this here and see what we got. So was that the only trade? No, actually, there's a fair amount of trade in this future style margined option. So and a lot of it, pretty good amount. I see 1,000 lot of a spread, a 2,000 lot of a covered. Well, that was a 2,000 lot was the call spread. So that's the one I think where people are going to move toward. I think that was the expectation when they added that product to the oil slate. So again, and you could do the same thing I just did. I just typed in futures-s and it showed me all the Brent crude oil future style, or if you know the symbol, which is a little bit more weird, it's BZ0, but you can type in here and search phonetically, search by symbol. Take a look. I'm doing some selling today, Mark, huh? More than usual.
You're all over it there, sir.
More than usual. But
Nick,
go ahead, Sean.
Just to jump back in. So future style options mean initial margin futures like a future spread, and variation margin is the same, right?
I believe, since you're the former clearing guy, you're going to have to answer better than I will. But I think it's all margin. It's obviously margin oriented stuff that the cheaper trade. But I don't know again, you can go to the product browser on QuickStrike and click on the contract specs link, and you can also read more about that as well. In fact, while we're here, I will do that so we have a definite answer. I don't know 100% certain answer to that, Sean. So I will tweet out the specs, and this way somebody will find that, and we won't let them down if they're actually looking for that answer. So let's see what we got here.
It is exciting to see that, though.
Yeah, no, it's good. Any Brent volume on there is always a positive. So here we go. I'm going to copy this link and I'll tweet this out. As far as anything else that Mark, we talked a little bit about whether the rally would continue, or how, we also mentioned last week how we just are never sure why people want a product that they're, as Mark put it, naturally short to continue to rally, right? Because it just costs everybody. It costs everybody in the long run. So maybe that answer is still out there. I'm not exactly sure what the answer to that is. But if we look at the term structure of the futures, it doesn't look like there's much expectation for this market to continue higher. So we have, and I'll tweet that thing out as well. We have the March contract, which has the highest open interest, that's trading in 63 and change, and then you go out to the December contract of this year, and that's at 60.5. So that tells you what they think, and then you have your information about from the EIA, and then you have the increase. Maybe this is where the shale kicks in, like you said. So I don't think it looks like there's much of a rally left in this, or much of a move higher. So it will be our job to pay attention to see what happens with this options market in terms of volatility, because we didn't have much movement in the volatility all week. So if we continue to kind of go sideways again, I think we're going to see it get whacked a little bit. It's still keeping its gains from the last couple of weeks on the move up, but that may not be the case if we continue to move sideways. As far as anything interesting from a vol standpoint, as you mentioned, pretty flat across the board from a at the money movement. Not much going on with the future, down a buck, but the skew really not any change either. So a little bit of a little bit of more put bid, a little bit more call offering if we look at our more meaty March and April contracts. But outside of that, 90 days out, we didn't see too much of a change in the shape of the curve. So a little bit better bid in the puts, as you would expect, as we start to peter out on this rally. A little bit more offer in the calls, same thing, right? So maybe we find sort of that market equilibrium again, where people think we're going to trend. So they'll beat up the calls and start to see if there's any puts that are available for them to potentially take advantage of what the term structure in the futures looks like from a absolute market movement standpoint. So, but other than that, you mentioned it, still good increased open interest. Not getting much from the weekly still, from what I can tell. But lots of volume, lots of change in open interest. This market continues to impress in terms of liquidity and availability of trade, especially given that I think we're going to get tamped out here a little bit on the upside. I wonder what the others from your other shows have said. Did they say anything about what they think oil's going to do going forward?
We haven't hit too much surprisingly on crude, but it does seem like all this news coming out of the this increasing boom of U.S. production, it's got to be at least a near-term weight, you would think, right? A little bit of a near-term headwind. If they're talking about U.S. overtaking everybody else, that's can't exactly do well for at least near-term WTI numbers. Speaking of crude, we can probably talk crude, all day here, the rest of the show, Nick. But our listeners and Sean, our listeners have been bugging us of late. They want us to get into some ags. We haven't had a chance to rotate ags. In New Year, we'll kick things off with a little bit of some ags here as well. I'll let you pick your poison, Mr. Nick. Which ag are you feeling in your bones we really should rotate? I threw out a little quick poll out there, but it's only been up for like a minute, so we can't really judge by that. I was too late on the draw on that one, unfortunately. So which ag are you feeling? Corn, soybeans, something else?
Oh, let's see. Give me 2 seconds, and I'll tell you what I think. Let's go with the beans.
All right, good, because I have soybeans open in front of me. If you had said something else, I'd have to scramble for a minute to find it. But instead, I will dive into all things soybeans. Soybeans actually another reason why you guys wanted us to talk about it. It's been moving a little bit. The soybeans up about 20 handles on the week, closing right around 980. That's a pretty decent move, about 1.5% here on the week. And soybean options doing another one showing pretty decent OI growth this week, up about 5% here on the week. So it's been a good options week for pretty much all the products here, Sean, what we're talking about here. Everything's good. 2018 off to a rocking start for all the options products. And number one with a bullet out here, again, you guys can follow along, cmegroup.com/TWIFO, was in the March contract, 42, almost 43% of the paper going up out there. Now, the ags usually have their own kind of rules of engagement. They trade around their own planting and harvesting cycles. So the way the options term structure plays out, usually a little bit different than something like a WTI, where pretty much all the action all the time is in the front month. So we see things active, like the weeklies out here doing pretty well as well. Actually, also the Feb contract, which is effectively a weekly now with about 7 days to go, doing about 7,200 contracts this week out there in the 980 calls. But the number one with the bullet was the par 1,000 calls. Understandably, we're getting close to that strike out here in March, doing nearly 23,000 this week. The lion's share coming actually on Tuesday, nearly 9,000 going up that day. About 5,000 total net opening on this strike. So not surprising, we're rallying towards 1,000. People are maybe positioning for that extended run, or maybe riding against it, trying to harvest. I know back about a year and a half ago or so, we saw a really favorable setup for collars out here in soybeans. I'll let Nick, no spoilers, I'll let Nick get to that in a minute when he talks all things skew out here. But that was kind of number one with a bullet. Then we drop off a little bit to get to number two, which were the surprisingly 980, the at-the-money calls here, also in March, doing nearly 12,000 contracts. About 1,200 at the opening. The lion's share actually coming today, which is kind of interesting. So a little active day for upside here in soybeans. Then we have a bit of a tie for third with the 960 puts in March, and the 980 calls in Feb, actually. Both kind of tying with about 7,000 and change going up. We'll start with the 960 puts doing about 7,600. The lion's share coming today again. About half of that paper come in today, and slightly opening net on the week, a little less than 1,000 contracts. The 980 calls, though, also today leading the charge out here. Again, this big move coming in, I guess, today, driving a lot of the call paper. 7,200 total on the week, about a net, about 100 opening. So slightly opening here on the week. Let's see if we can scan really quickly for any aberrant block paper here, Mr. Nick. I'm not seeing anything too crazy out of the ordinary here. Some 940 puts going up out here in July, but other than that, nothing really lighting up my tape. What was lighting up your tape, sir, from a skew perspective? Now, people always ask us about skew and beans. What are you seeing out there in the bean skew this week, sir?
Well, I'll step back 1 second. So everybody is aware now, they just recently started allowing block trades on the ag markets. So seeing more of that come out here on a daily basis. Not a great deal, but still it's a starting point. So and I think you'll see more of that happen. I see a non-fat dry milk option on the block here, a risk reversal, and then some black sea wheat financially setted Platts futures. So some blocks to come in the ags. But what do I see out here? You know, we have not done a good job paying attention to this since we had the crazy quick skew days. Probably, what is that, over 15 months ago, right? It had to be.
Yeah, a little over a year ago. Yeah.
Yeah. So it was a while. We were spending a lot of times on the beans, but interestingly enough, if we're looking at the 30-day plus quick skew, we had a big change in the way this curve looks. So if you get a chance out there, and I'll tweet a quick skew chart so you can see the change. But we saw the calls go from pretty much flat to at the money to a 7.7 on our quick skew absolute percent rich cheap. So 7% rich, almost 8% rich, and the puts went from 2% cheap to 5% cheap. So that's in the 34, 35-day contract. The 60-day contract, calls got bid as well, puts got offered. Same thing in the 90. So a big change, a big tilt in that in the shape of the curve. And I'm going to push this one out here right now. Yeah, in fact, Mark, it's pretty interesting when you see it. I'll tweet this out and make sure that you are on here. And our listeners can take a look at this, and you can shoot this out there. So a big change in the shape of the curve. So there potentially was some lost opportunity there. I don't think it was any wider than it has been, but maybe take a look and see what it looks like historically on the quick skew chart. 30 days of which are free and available if you register for Quick Strike Essentials, which is the free version on the CME Group website. I feel so dirty when I say stuff like that. Even though it's free, I'm not getting anything out of it. I just don't know what it is about, self-aggrandizement. I'm not a huge fan. But anyway, so we have to pay attention now, Mark, because the skew flips so hard on this.
Yeah, I'm looking at this chart. It's pretty impressive. You said it hit a nice little inflection point. It looks like about a week or a few sessions ago, and it seems like everything's kind of changing up.
Yeah, so, I mean, I'll have to do a little bit. I mean, it could be the fact that, we did rally pretty hard and then come back off. Well, that was today even. Let me look at the 5-day chart, looks like. Yeah, I mean, we're pretty flat last week, and then we pushed up higher, so it must be on the push up. So maybe there's an expected. I didn't see any news. I didn't pay attention necessarily so much, but that was a big flip today. So I mean, or this week. So something happened from a perception standpoint of which way we're going. So the calls definitely got some wind beneath their wings, and the puts got a little bit offer, which that makes me think that maybe this is going to persist a little bit longer. But that's the interesting stuff here. And I picked this one because it had the bigger open interest change. So that means that, and I looked at corn, so that's why we picked soybeans, because it had a bigger net change. So we thought it might be a little bit more interesting.
Yeah, and I put that poll out late, so we didn't get a chance. Some people voted for corn, but we'll get to corn maybe next week, listeners. Meanwhile, though, we got to keep rolling. You guys got questions? We've got answers. It's time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options. facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback, the portion of the show where you guys ask us questions. Sometimes we ask you questions. Nick, I think we're contractually obligated at this point to have this also include the Bitcoin because people keep hitting us up with Bitcoin. So maybe we'll start there. It was a crazy week. Sean and I were talking before the show started about just all things crypto. Huge sell-off beginning of the week, some rallies later in the week. So if you wanted to vol and you didn't want to trade index for some reason, crypto was certainly a place. Granted, listed options, not exactly there yet. But how many people were hitting us up this week saying, oh, my God, if I had only had a put on Bitcoin, what I could have done this week. So yeah, we feel your pain. Doesn't seem like options are coming anytime soon, listeners, unfortunately. So let's just all role play. We asked you guys this week, back earlier in the week when the futures were around 11,500. We said, hey, let's pretend the options existed. If the options existed and you had to trade for a 1 month expiration, what would you do? Gave you 4 choices, pretty simple stuff. Would you buy a 5% out of the money call? Would you buy a 5% out of the money put? Would you sell a 5% out of the money covered call, or would you just say the heck with it and short the future? Sean, you're our guest. You get pride of place here. What do you think our audience is voting for here in this poll? What do you think resonated with them the most? Do you think they're buying calls, they're shorting the futures, they're buying the puts? What do you think they're up to?
If they were trading this, they'd be buying the strangle, the out of the money call, and the out of the money
strangle.
put.
But you see your pick. You're going off book here. You got to go with our 4 choices.
You need some A and B, A, B, and C, all of the above.
Take it up with the Twitter folks. They limit us to 4. See, he comes in the studio, Nick, and he's already ordering off the menu here.
I get complicated immediately. I'm an old options trader. I'm sorry.
I want it to be an iron condor swap with the ratio on the second leg and all that.
I want a Christmas tree and the downside puts. Yeah.
I'm going to put you in for buying a call or buying a put. Which one you want?
Calls are puts and puts are calls synthetically, right? I'm sorry to get into options stuff for you, so right, I could buy either one.
I'm going to put you down for buying the call just because you sound
I'm a
bullish.
buyer of volatility.
You sound bullish
that?
to me. There you go,
yeah.
Buyer of vol. Mr. Nick, do you have a more concrete answer or do you have a more political type answer here like your buddy Sean?
Oh, yeah. I can go off exchange because I'm not beholden. I like the covered call, the selling the call covered, so I like that.
And I kind of thought there would be just a tidal wave one way or the other with our audience, but our audience is actually kind of split. I was kind of surprised. They're coming in. This has got about a day left or so, listeners. So if you're listening to the podcast, it's probably too late. But if you're listening live or coming into the site after the fact, you can actually got 2 days left. So you might have a chance here on this poll. And so far, with a couple days left, it's actually pretty surprisingly even. 35% saying they want to buy the out of the money put. I'm sure a lot of that, coming in earlier in the week, maybe biased by that big sell-off week. But then hot on its heels, 27% saying buying the 5% out of the money call. So you add those two together, Sean, and you were right. The strangle is very popular. And then 23% saying they just want to short the future. And only 15% saying they want to sell the out of the money covered call. But synthetically, that's like selling a put. So we didn't feel like putting both of those together. It's getting back to your option specifics there, Sean. Since we're talking Bitcoin, Nick, this one came in last week. We didn't have a chance to talk about it, but I know you have some data on this. Came in from Alfred. He's asking, why aren't the CME Bitcoin futures listed on the COT reports? The COT reports, of course, listeners, are the Commitment of Traders reports put out by the CFTC. It's listing, some products, but not others on there. People are confused. I know, Nick, you got some good data on this. Why aren't we seeing the CME contracts in the COT reports?
I think that even though the contract is a larger 5-coin contract, from what I talked to Tim McCourt, I did ask them because I just assumed that once that contract got listed, it would be available in the COT report because the CBOS was available right away. But I think they want a more widespread group of people holding, and I believe the number is 20 contracts each. So they need to there has to be multiple places where there are at least 20 in open interest at that particular. I thought it was 20 and 20. I'm not exactly sure what the number was, but not enough people had large enough positions for them to warrant it listing, even though from a pure exposure standpoint, it's no different than what the SIBO has. In fact, it might be higher at this point in terms of the number of coins exposed by the futures, but it wasn't the absolute number of holders wasn't diverse or widespread enough for them to list it. They weren't going to budge on that from that standpoint, which I thought was odd. I would think more it would be a notional thing more than anything else, but it'll get there eventually. I think it'll get there.
Yeah, I was surprised by that as well. We got this question a lot last week, and until we got this question, I hadn't really done any digging to realize that there were actually thresholds. I assumed all activity was just reflected on the COT reports, but apparently there are some thresholds in terms of minimum users and reportable positions and things like that they want to have before they'll put it on the COT report. So that's why we're not seeing those yet, their listeners. Plus, it's also seeming a bit of a disadvantage here because they picked a bigger contract. It's a 5-coin contract, which I'm sure maybe made sense when they were first creating it, but when the coin was trading almost 20,000 each, that became still pretty meaty to this day. A lot of people asking about, Mark Brandt was asking last week in the chat about ags. He wants to know if ags were hot this year. What's the bugs at CME per ags or soft? We just did some ags for you there, but we'll get more ags in. We also got Camper asking, he asked a while ago, maybe we'll get this on the show next week for him here, Mr. Nick. He wants to know, do we notice any interesting patterns in corn volatility skew ahead of crop planting or harvesting? We'll tell you what, we just did soybeans. We didn't get a chance to do corn. I promise you, Camper, and all the rest who are listening and asking about ags and corn, we'll do corn next week. How about that? We'll also gives Nick a week or so to do some digging, do some homework on the skew evolutions around the planting cycle. You got that down in your book, Nick? I'm writing it down now. Your homework for next week's show. Our listeners are so demanding. They want us to do all this research for them. They ask so much from a show they get for free. But c'est la vie. We like to make our listeners happy. So we'll do a little bit of digging for you, Mr. Camper, and we'll see if we can come up with some answers for you next week. Here's an easy one. This comes from Daily. He says, can I use Quick Strike to compare and contrast skew charts for the indices to try and find trading opportunities, he says, between SPX and Dow or SPX and Russell and all that? Thanks. Well, we were kind of just doing that. We were just doing that a minute ago, weren't we, Nick, at the top of the show, looking at all the different skew differentials between the Russell and things like that. Maybe he's asking, if I can maybe interpret for him, maybe he's asking, is there one place I could find maybe a compare and contrast of all the skews of all the indices in one screenshot? Maybe that's what he's asking.
We have a quick skew report that's sort of a look back at the year, and it will show you some averages. I'll tweet it out. It'll show you some averages against. So what do? We look at a year's worth of data, and then we show an average for 1 month. Let me get it so I don't remember 100%. But yes, you can. I don't know that I necessarily have Russell in that index list because we don't have enough information, but you definitely have anything else that is liquid and been around a while was going to be part of that report. And there's also a way to go into, even in the free version, the Quick Vol Essentials version that's out there on the site once you register, if you're not already registered, or you use your SmartClick, your CME website login, you can get access to that information as well. So we have, in the report, I'll tweet this out, we have the S&P 500, the NASDAQ, and the Dow, and this will do some comparisons. I'll push this out right now. I pushed this out last week, I think, too. This is a great report. This takes the average 30-day 25 delta constant maturity quick skew and we call it the benchmark report. So it looks at all of the more popular or products that have been around for the longest period of time that are actually trading. So Sean will get the Russell in here as soon as it has enough time to fill in some of those cells. And so you can.
Thanks,
so
Nick.
you can look at you can look at it on a table like I'm tweeting out. You can look at it on charts and do comparisons, or you can, in some of the versions of Quick Vol, you can do downloads and pull it in Excel and do whatever work you want to do from there. So yes, you can. Long answer. To a short question, yes, you can.
Our listeners, they want so much, Nick. They want everything. They want this. They want analysis of skew around planting. They want to be able to compare and contrast all the indices in one fell swoop. You know, they're a demanding bunch, but they're a loyal bunch. So we gotta be loyal to them. Too. This is a good one. We kind of was talking about this earlier on the show, Sean, as well. This comes from L. Romero. He or she asking, do all indices have the same issue with other money puts being so outrageously expensive? Where can I go for cheap? I think he meant protection here. I'm going to assume that's what he's writing, or she. So Sean, all the guy wants is some cheap puts. We talked earlier on the show. Russell does tend to exhibit some different skews. What do you have to say here for our friend, Mr. or perhaps Mrs. El Romero?
A couple of things, Nick, and please jump in here. It's been a long time since I've traded options, but back when I was an equity derivatives trader on the floor of various exchanges, my portfolio manager gave me some really good advice to hedge my portfolios in various products that I had positions in. And I was told, buy puts when you can, not when you have to. It's a very, very good advice, because when you go after them and you need them, they're going to be at a much higher premium. So again, there's lots of, I think, option or put writing fatigue because the market's been on such a rally. If puts still seem too expensive for you, I'm a spreader. So put spreads are the way to go. They are much less expensive than just buying outright downside protection.
There's a whole industry. Some might say a large portion of the options used in institutional asset management is pretty much all devoted towards paying for that put. A lot of people, that's all they do all day long. They try to find calls to write, out of money puts to write against the put. All they do all day long is try to pay for that put. So you're not alone here, Mr. or Mrs. Romero here, that you're not the only one feeling that pain. That said, certain indices like the S&P and others, they tend to exhibit it more. The puts are always juicy. It's just a question of how juicy they're going to be at any given time. So if that puts you off, and then maybe some other indices are the places to go. Like Nick was just alluding to, it is a rare thing to see a major broad equity index like Russell exhibiting any other type of shape of skew. So that's kind of what interests you, and that's what we're talking about here. Of course, talking about skew at the end of the day, what the premium is for the puts versus the calls, and indeed against the at the money. That's certainly interesting. I mean, Nick, you were just talking about this earlier in the show. We're talking Russell, how it seems to be one of the few, if only, games in town when it comes to a major index that's going to exhibit, let's say, just some other type of skew shape for variety. And that's certainly a welcome thing, is it not?
Yeah, I mean, looking back again at the numbers that we talked about a little bit at the beginning of the show, last Friday, Monday would have been the time to buy them in terms of looking at what, from a historical standpoint, what they look like, because they were much cheaper than they were cheaper than they were or are ending this week, but they're still a lot cheaper than the other indexes. So, Sean, that's actually, was that at O'Connor? Where'd you get that advice from? Who?
Yeah, at O'Connor.
Oh yeah, was it one of the partner guys?
It was a senior portfolio manager who's now a very big senior guy at JP Morgan Asset Management.
Okay, yeah. So that sounds like something those guys would say. But what a great advice. But yeah, you don't get a chance, and that's the thing. I mean, and I think that's why that article came out earlier this week, where, they just hadn't seen. And if you look at it from afar, like if you look at it from afar, it doesn't look like the channel squeezes very much. But from a percent toward the at the money for each of them, you did see a dip in there. So there's going to be opportunities. It may not look like an absolute opportunity. Like when you look at the numbers, you go, oh my God, it's so expensive. But when you look at it relative to historicals or the average over a period of time, there's probably still some opportunity out there. So I think you could take a look at the Russell or the E-mini S&P. And for the life of me, I can't figure out why the Dow doesn't trade more as an option. It just makes no sense to me. It's the number everybody knows. I just don't get it. So, but there's nothing out there.
Yeah, there's never been love for the Dow. I don't know why. They launched with a great fanfare when I started over the CBOE, the options there. Obviously, CME has them, and yet for whatever reason, it never really became the big thing everyone wanted it to be. We'll wrap up here on this was a nice, easy one, or perhaps maybe it's deceptively hard. I'm actually kind of trying to puzzle over the question and the answer myself. This comes from Condit. He or she asking, what is the shortest duration option contract available on Globex. Obviously, we know they have weeklies. You talk about them all the time here. So I guess effectively, when you're talking about a weekly that's going to go away in a day anyway, it's kind of like a daily, is it not? Sean, you got any guesses here for our listener? I know you're an old school CME guy. Are you going to guess weekly, or do you think there's actually shorter duration? There's maybe some dailies lurking in there.
Not exchange listed. I think weeklies is the shortest.
Yeah, that's kind of where I'm leaning. I don't know, Nick. Do you have a contrary opinion? Or are you going to say that effectively, when a weekly gets to 1 day left, it's kind of like a daily? You're going to cheat.
No, I know for a fact that because we price them, they're called, well, for instance, in the crude, I think in the crude and the nat gas, they have what their insert product here, short-term options, and they are listed as 01s, 02s, 03s, and it's the day of the month. So you have dailies. So you have something that's expiring every day, and then 5 more behind that. So like today, you have one that expired today, then one expires Monday, which would be called, what would that be called? That would be called the D22. So you have one expiring D22, D23, D24, D25, and D26. And then when the 22nd rolled off, you'd have one that expired on the 29th. So you have something that basically expires inside of 1 day, every day. Those trade on Globex for both the crude and the nat gas. So there you go. You learned something today.
I did learn something. I knew if I tossed to you on that one. I had a sneaking suspicion it wasn't just weeklies, that something in some esoteric product would be lurking there, would be effectively a daily. And here you are, the man with the data, to give us the exact answer. That's why we have you on the show, Nick. You have the answer to these esoteric questions. There you go, Mr. and Mrs. Condon. Hope all your listeners are happy that you wrote in with your crazy questions. We gave Nick a lot of homework for next week, so he's probably going to be grumpy after the show. Good thing he's not in studio. But that music means we come to the end of another epic sojourn, and what a sojourn it was. We started off in index land, talking all things Russell. Then we got off into crude, and even got into soybeans, a bunch of your questions. But before we go, one last time around the horn, let's start with you, Sean, because we know 2017 was a pretty big year for all things Russell. What can we look forward to coming down the pike from you guys now in the early 2018?
Volume and open interest in 2018. That you're hearing that from me. Also, I just wanted to say thank you, Mark, for having me on the show today. And Nick, it's always good to connect with you again too.
It's always fun to talk a little bit index. People always ask us about index here on the show. And then also talk a little bit something different. We talk S&P and other things a lot, but they're kind of, the skew is the slope is different, but the skew is always kind of the same. So we like talking products that can have a little bit different, bring a little something different to the table. And looking at the numbers just to start this year, it seems like Russell off to the races yet again. And don't forget about RVX. We'll be talking about RVX. Next time you come on, we'll definitely be
absolutely
talking about
RVX. We'll make that a topic next.
One of my pet products. I've always had an interest in that one. It just makes sense. It's like chocolate and peanut butter, two great tastes that taste great together. You have a very structurally volatile product on one hand, and you have a volatility product on that product. It makes sense. It should go. So I'm looking forward to seeing more from that in the coming weeks. And Mr. Nick, you guys are always changing up the quick strike thing. In fact, you throw me for a loop every week on the show when I log in, and everything's changed. So what are you guys working on for all things quick strike this week?
Oh, well, I mentioned last week we had a big build that went out this prior week, so we did a little bit of change to the layout, but we made it so everything's sort of single click away. So that's a positive. And this I will push for everybody to take a look at. We released, and it's in, there's versions of it out in the free site. We released a new spread builder, so a new trade analysis tool, which is really, really nice. So you got to take a look at it. We have some new calculators, so you can do, price to vol, vol to price, but multiple contracts at the same time, and just some advanced future stuff that's also in the essentials version only. There's no embedded version on the CME website. It's within there, but just we had a great release of new tools, more stuff coming down the pike. We'll have a good crypto thing coming out within the next month as well, so you'll be able to get your fill there. And that's going to be something that you're going to have to line up for in terms, there's no freebies on that one. And just keep an eye out. We're doing some more advancements out this weekend. And I'll say it again, make sure if you are using CME Direct, make sure you click on the Quick Strike button, because there's some good integration there, good way to build trades within there, and even send those trades back to CME Direct. So keep an eye out. Always new stuff coming around.
There you go. No freebies when it comes to crypto. It's a hot thing. Everybody's got to get their hands on it. Of course, head on over. I'll do the plug for you, Mr. Nick. Head on over to bantix.com. It's BANTIX.com. Click on that sign up for QuickStrike. I literally, if you're trading these products and you're not using QuickStrike, I honestly don't know how you're doing it because it's kind of the only game in town. You need something to do your analytics for you. Let Nick and his team do it for you, and then you can give them homework. Like, hey, compare and contrast the skew of corn for me before plantings, like we'll do next week. We're looking forward to that. On behalf of Sean and Nick, and indeed myself, I want to thank all of you for joining us here on the old TWIFO program, and we'll see you next week for more Futures Options action.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered. With market data reports ranging from open interest to the term structure of volatility, QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.